now that interest rates might be stabilizing and the real estate market is favoring buyers, you might be thinking about slowly getting back into real estate. But now with worries about a possible recession, it might be confusing to figure out what type of real estate to invest in. Now, if a recession does happen, what types of properties in Toronto are actually likely to be more resilient and perform better? If you're new here, I'm Samantha Chan from Elevate Realty, and our brokerage wants to help you make smarter real estate choices in Toronto. Don't forget to like and subscribe if you enjoy our content, and stay tuned for the answers to what we think the strongest real estate investments are during a recession, coming right up. Let's talk about condos first. They're fancier, but here's the thing. If our economy is not doing well, people tend to choose more affordable places to live in. So think about the people who rent condos. During good times, office jobs are great. But if there is a recession, these types of renters actually end up being riskier compared to essential workers like hospital workers, construction people, or even students. So in a recession, condos are actually more likely to see higher vacancies and ultimately more rent fluctuations. Now, let's look at what happens next. When tough times hit, landlords who are already struggling with tight condo cash flows might have to sell their homes. And if we check the data from the last recession in 2008, condos actually saw a clear downward price movement during the recession because of this. But then, because rates did come down pretty quickly last time, investors ended up flocking back with cheap credit pretty quickly, and Toronto condos ended up reaching new highs sooner than other types of homes in Toronto. Now, when we talk about condos, we sometimes get asked about pre-cons. Here's what we think. If you can't afford to buy a condo that's already built, we'd say definitely go with that, because pre-cons are actually a lot more risky. First, there is the risk that the property won't be completed by the developer, and there has been more recent issues with this. And second, there's also a huge price risk. The property's price has to be at least what you paid for at the exact time of completion to make sure your financing is okay. And since you won't be making any rental income until the property is ready to close, your investment risk is very focused on price, making that concentration risk a lot riskier. Now let's talk about semis next. During the recession last time, semi prices did swing, but it was more of a sideways movement compared to condos, because demand is more balanced in general from both end users who actually need a home to live in and investors who generally have better holding power with higher total rents, more affordable rentals, and more units spread out to spread out your risk there too. But with fewer investors in the mix, they ended up taking a bit longer to reach new highs after the recession compared to condos. Now let's move on to detached homes and look at the last recession. And data tells us that they actually are the least to be affected by the recession, because these homeowners generally have better financial situations and less debt, making their homes more stable during tough economic times. But because of the same reasons as well, detached homes ended up taking the longest to reach new highs after the financial crisis. Now, one more thing we want you to avoid are commercial rentals. These kind of spaces are definitely more influenced by economic downturns, so we'd say it's a better idea to go residential if you were to invest in real estate, because everyone still needs a home to live in. Now, what happened 15 years ago can give us some clues in terms of what is to come. But remember, the situation today isn't exactly the same as what happened 15 years ago. In the last recession, interest rates went up a lot more slowly, going up by 225 basis points over 3 years, and that's why prices were close to its highs at the start of the recession, and then dropped by 15 to 20% during the recession. Now, this time around, rates have gone up twice as fast in less than half the time, and that's why we've already seen that 15 to 20% price drop, and the recession hasn't even happened yet. Back in the last recession, interest rates also fell a lot, more than 400 basis points in a year and a half, and that's why condo investors jumped back in pretty quickly. But this time, we definitely don't expect interest rates to drop that much that quickly, and that's going to affect how quickly condos and other real estate investment prices bounce back too. Another thing to keep in mind is that government policies have also changed since then. Back in 2009, policymakers were just focused on building more housing, and condos were a great idea back then. Now, the government is definitely more focused on missing middle type of projects, i.e. houses. Finally, gentrification patterns have also changed over time. For example, Leslieville saw a lot of gentrification 15 years ago, but now it's actually pretty mature and nice. So you can't expect the same high growth this time around since gentrification has actually shifted elsewhere in the city. So based on these changes and also what happened in the past, what do you think might be the best thing to invest in? Well, we definitely think it's wise to invest where the government is putting its money, so houses would be a better choice compared to condos this time around. And you might end up seeing outperformance in the more affordable Toronto neighborhoods that are starting to get better. And if you're looking for stable rental returns, you should consider semis that are divided into multiple units already. Having more units, being more affordable types of units, usually means safer rents. And from what we've seen also in the last recession, semis also recovered faster than detached homes, so they do have an advantage here too. And finally, in our current buyer's market with high interest rates, you can definitely get better bargains if you buy a house that needs a lot of work. We know it's not for everyone, but if you are up for it, taking on these projects can lead you to better returns. So hopefully this helps you narrow down your scope a little bit better. But of course, if you do need help, our team is here for you. We're not your typical real estate sales brokerage. Instead, we focus on using numbers to make better real estate decisions in Toronto. And that means looking for stronger investments with positive cash flow, thinking about risk management, and looking for ways to boost returns like value add renovations and gentrifying areas. If you want to discuss your private real estate situation with us, just head over to this link here to set up a time to chat. You can also check out more of our content on our website or find us on social media. And if you haven't done so already, please like, subscribe, and share this video if you think someone else might like it too. Thanks so much for watching, and I'll see you in the next video. Bye.